if you recall, we are thinking about valuing Walmart using the three common methods: comparable company analysis, discounted cash flow analysis, precedent transaction analysis. So we don't have time to do the whole comp analysis in 30 minutes. It's going to take a couple of days, so let's do PPAs, get that out of the way. We had spent a couple of days to the discounted cash flow analysis, and we've come up with a range of around $88 to $97 based on both the EBITDA and perpetuity method. Comparable company analysis, we have yet to fill out. I mean, it's been done except for Costco, so we're going to use Costco as an example, assuming that's a comp for Walmart. There are really no comps for Walmart is the problem. And then there's precedent transactions analysis. So a couple things with precedent transactions. One, we mentioned precedent transactions are very difficult to find. If you do find them, it's very difficult to find the actual information to back up that information. And so what we did through kind of Googling and external research, we found other acquisitions of kind of big box retail stores that happened in the past. And it was tough to find anything after 2007. That's another problem, right? The biggest drawback of a precedent transaction analysis is it's dated, usually. This is acquisitions that have happened at a time. The markets are completely different in 2007. Now remember, this is for an analysis that was done in 2013, so maybe something's happened in the past couple of years. Office Depot, Office Max, maybe, would have been good. That's what the M&A book is about. But okay, let's pretend we're here, and let's say we found some of these situations by googling around, acquisitions, doing word searches, and we found several of these acquisitions, and now we have to find the underlying data and calculate metrics. We talked about multiples. These are purchase multiples, not trading multiples. Recognize the difference. We'll flush out the difference in M&A. But a trading multiple is, price to earnings based on what the company's current stock price is, right? An acquisition multiple, price to earnings, is the price paid for a target company divided by that target company's earnings. So make sure you understand the difference, right? PE in a comparable company analysis is how much is a company trading for. PE in an acquisition is how much is a company paying, how much is somebody paying for a company. So let's say we want to analyze further this acquisition of KKR Dollar General that we found in some news releases. What you want to do is you want to find, hopefully, some public filing talking about the acquisition of Dollar General. There must be a public filing out there because Dollar General was public at the time. If it was a private company that was being acquired, you're probably not going to find anything. It's another difficulty of precedent transactions. So we're going to look for Dollar General, and we're going to look for financials for Dollar General as of July 6, 2007. So I'm going to go to sec.gov, and I'm going to pull up search SEC documents Dollar General. Go. And that's going to pull up a bunch of documents. I think it'd be easier if let's see if it pulls it up this way. Okay, well, it's going to pull up. Well, an easier way to look at it is, let me just go to, hang on, let me swing back. Go to company, let me just go directly to company filings because it was pulling up other litigation proceedings, things like that. Company filings here, I'm going to type in Dollar General and company name, search. Dollar General Corp. That's what the actual company entity is. And so, they released it back out to the public. Yeah, so, but I'm looking for the KKR acquisition as of 2007. What was the exact date? July 6, 2007. So I'm going to do prior to 2007. I'll just do 0801, August 1st. So look for filings prior to August 1st, 2007. And so you're going to see a lot of filings. You want to dig through these filings, and you want to see something related to the acquisition. So this was announced on, I believe I said July 6th. Let's look at this 8K as of July 6th, General Corporation Form, July 6th. Let's see what that talks about changes of control. This is just a page. Nothing significant. So let's go back. Whoops. And you have to kind of go through this process to kind of find an 8K or a proxy or a document that explains and talks about the situation. Let's try June 21st, 8K. And I'm just giving you an example of Dollar General Corporation, filed June 21st. And this is just another update, nothing too significant. And this might take you a little bit of time to climb through, but I know through doing this that there is one on June 15th. I believe it's in the proxy. For some reason, the book shows Form 8K, but this should be released in a proxy. In a proxy document, did we talk about proxies yet? I'm thinking about the last group. A proxy is a solicitation to shareholders, usually to vote for the approval of something like an acquisition. So when you look at proxies, this is a proxy document, it's going to be more than just an 8K is an announcement or some sort of disclosure. And usually 8Ks are helpful because they usually come with some financials. But a proxy document is a lot more detailed. Okay, I clicked proxy, but it said Form 8K on top. I think the 8K is attached to the proxy. The 8K is probably the announcement of the proxy. So this looks like the right document. They're speaking about the transaction. Is this going to be the acquisition? The acquisition of Dollar General. So this looks like this is going to be it. Sources and uses of funds. This is definitely it. Right? We'll talk about sources and uses of funds in terms of acquisition. But sources and uses basically tell us the uses of cash is in a transaction where the money is going and the sources where the money is coming from. How is it being funded? So this is the situation that we want to look for. And it's important to note, in a proxy we'll have significant financials. This is the entire balance sheet of the business. We can use this to analyze the situation. Here is the purchase price of the business, $7 million, which is going to be helpful. And so on. Here's the consolidated statement of operations, the sales, the profit, the net income. This we'll utilize to calculate our multiples. So we can use all of this information to back into our respective multiples that we'll use to analyze for Walmart. So the information that we need is the purchase price on a market value basis, the purchase price on an enterprise value basis. We obviously spoke about market value versus enterprise value. Enterprise value is market value plus net debt, plus some other things, non-controlling interests, other non-operating obligations. In a purchase multiple, the enterprise value is the price paid plus the net debt assumed in a transaction. So we'll talk about in M&A, when you're buying a business, you have to raise money to pay off the shareholders, but you also might be responsible for raising additional funds to pay off the company's debt obligations. Right? If a company has debt obligations in a transaction scenario, maybe, let's say, Chase Bank has lent this company money. If there's a major company event like a change of control, Chase Bank might say, well, I don't want to be responsible with the new buyers, and I want to get paid back. As a buyer, you need to be responsible for raising additional funds to pay down not just the shareholders, but the lenders. So the price paid for the shareholders and the price paid for the lenders is the enterprise value, equity plus debt, the enterprise value. So we need to figure out not just the purchase price plus net debt assumed. And then to calculate our equity value multiples, which is our equity value to earnings or our PE, we need to get the company's earnings. And to get our enterprise value multiples or enterprise value to revenue, we need to find out the company's revenue. For EBIT, we need to find the company's EBIT, EBITDA, we need to find the company's EBITDA, etc. And Unlike the comps. So in the comps, we're going to have a table, we're going to have an income statement. Present transactions, I'm just going to, for simplicity, just bury numbers right into here, just to show you where to get the information and how to get them all. It's going to be kind of quick and dirty, they call it this, right? So let's look at what the market value and what the purchase price is said to be. So I'm going to go back to the document, and I go to the first table, the sources and uses. Oh, where did I lose it? Where's my, what happened to my Internet Explorer? Okay. Go back to the top, to the first table, sources and uses of funds. This lists the uses of funds, the purchase price, 7003.6, $7 billion to acquire the business. So my purchase price is going to be literally 7003.6. That's it. And if you're doing P-Page the right way, I recommend adding a comment, explaining exactly where that number came from, printing out the page, keeping a file with that page, circling it so if an associate goes through it, you have the data backed up to the individual number. You can see in the other present transactions, they have tabs with the tables laid out. It's a little bit more organized. I just want to show you how to get the information. I don't want to spend too much time on this. Enterprise value is the market value plus the net debt assumed in the transaction. What's the net debt assumed? Right here. Refinancing existing indebtedness and other retained indebtedness. These two lines. 219.4, 67.7. So the enterprise value is going to be the market value plus those two items. 219.4 plus 67.7. That is the enterprise value of the business. Right? So, again, market value is not the trading value, it's the price paid. So same types of multiples as for the comps, just a little bit of a different perspective. Now, the underlying statistics, it's very important to lay out the last reported statistics of the company. Not after the purchase, not before the purchase. We want to look at how the acquirer was valuing the entity, was valuing their purchase price. And they value it based on the last reported statistics, presumably. So in other words, if we go down, let's look for an income statement to get revenue. This is a balance sheet. This is a balance sheet. We had seen it. Here's a statement of operations. There's the historical operations. There's the adjustments, and there's pro forma. The pro forma is the what the company's going to look like after the acquisition. We don't want to run multiples after the company was acquired. We want to run the multiples right before the company was acquired because it's these numbers that presumably the acquirer was analyzing the company on, was valuing the company on. Our PE multiples need to be based on the historical numbers. And it was really helpful for us that there was a document that laid everything out like this. Sometimes there won't be a document that's laid out like this. If there's not, you have to go to the company's K's and Q's to get the historical numbers. And you might have to do your own LTM and calendarization adjustments. We'll talk about LTM and calendarization for the comps. But for now, easy enough. Everything is laid out for us. So sales is 9169822. That's what I'm going to use here. So I'm going to use, okay, earnings. Well, now that I talk about sales, let's just do enterprise value to revenue, which is enterprise value divided by that revenue number. It's the 7290.7 divided by 9169822. Notice the units have changed, so I'm going to do 9169.822. It's going to be enterprise value divided by 9169.822. Again, I typically would never just hard code and mix formulas with hard coded numbers, but in this situation, let's just do that and footnote it in the, just for simplicity. Again, for the other ones, we got into a little bit more detail and actually had tabs where we laid everything out in more detail. Okay. Next, here's earnings, 137 0.943. So we'll do market value to earnings, which is 703.6 divided by 137.943. Remember, we want to adjust for units. 137.943. Okay with that? 0.943. Questions on that? No? Okay. Then we have earnings. Save this real quick. For earnings, again, we'll just go back to that table. And when I say earnings, I mean EBIT. And the EBIT is 248,276. It's operating profit. There's nothing in there that's extraordinary that I would pull out. Remember, you want to look for things that might be extraordinary that you want to pull out. Notice depreciation isn't separated out. We're going to have to do that when calculating EBITDA. So operating profit 248,276. So it's going to be the enterprise value divided by 248.276. 29.4. And then we finally get EBITDA. So we have to add depreciation. Notice depreciation isn't identified here. It must be buried somewhere. We have to look for the depreciation number. If you scroll down, this is just other timing. There is a table that lays out their depreciation. Well, here you go. They list right here EBITDA. And we're doing it as of the fiscal year 2007. 448,849. You could have, so depreciation is 200.6. So if you do the math, 200.6, if you take, where's the numbers that we utilized? If you take the 248,276 plus 200.6, that gives you the exact same number that they reported here, which was 448.9. So you can do it either way. So if I take the enterprise value divided by 448.9, I should get, whoops, wrong number. I should get 16.2. Yeah, 448.9. Pretty straightforward. You know, putting together precedent transactions. It's not the difficulty in the division. It's just the pain of looking through and finding the information. One thing that's important to note, and we'll talk about this more with Hines in the LBO. I thought this had it. It doesn't at the end. Is look for company fairness opinions. A fairness opinion is a valuation by a third-party investment bank that's supposed to give an unbiased valuation of a business. They're not supposed to represent the buyer, and they're not supposed to represent the seller. They're supposed to give you an unbiased representation of what the value of a business should be. And a fairness opinion is usually printed in a proxy document for the shareholders to evaluate and help give them information as to whether they should vote on the transaction or not. What's great about a fairness opinion is it gives some valuation results that is kind of more investment banking oriented than just kind of SEC accounting things. They'll show you EBITDA. They'll have valuation metrics. They'll have a DCF sometimes. And what they also will have sometimes is a list of comps and a list of precedent transactions. So another clue, this doesn't have it, but another clue is if you find one specific transaction that might be a good precedent for the company they're analyzing, and you look in their proxy document, look for a fairness opinion, because that analysis might have that bank might have done their own precedent transaction, their own comps. And you can look at those comp companies and those precedent transactions for you to use your own precedent transactions for. Don't use those precedent transaction numbers. You can look at those companies and say, all right, well, I should run my own comps on those companies, or I should run my own precedent analysis on those companies. It's just another resource you can go to look at fairness opinions. We'll do a lot of fairness opinions, and I'll show you that for Hines. So what does this mean? What is the analysis telling us? How do we interpret this analysis? We have some multiples we can analyze. PE, enterprise value to revenue, EBIT, EBITDA. Which one is important to us? How do we look at which one is important to us? What do you guys think? Any clue?
Enterprise value over EBITDA.
Why? Why enterprise value over EBITDA?
Because the EBITDA is going to give us the most, multiple, the most closely related to the operation of the.
So we spoke about how EBITDA, the underlying metric EBITDA, is most closely representative of the operations of the business. So you could consider enterprise value to EBITDA. Would you consider any other multiple? Just generally? And for that reason, most often we look to enterprise value to EBITDA. We spoke about that in some other valuation courses. What situations, maybe not in this company, what situations would we look at like let's say PE? Sorry?
Equity value.
Yeah, equity value of earnings. In what situations will we look at that? Anyone know? What types of companies, what types of industries? No?
If I'm looking at PE ratio, I compare it to industry averages. The reason why I'm looking at it is to figure out if what I'm paying for is overpriced in comparison to what the industry.
Well, yeah, that's a good point. So just generally stepping back, yeah, that's what this is supposed to help determine, right? Are you paying a value that's too high or too low? And you can say, well, let's see what other people have paid for these types of businesses. And you look at a multiple, and you compare that multiple to the company you're analyzing. But when, let's jump, and what types of companies would you look at PE? What types of companies are PE often the measure, as an example? Tech. A lot of tech companies are valued at PE. Why? Say it again?
They don't buy rating.
Well, okay, so maybe, a lot of tech companies use enterprise value to revenue, first of all, right? Enterprise value to revenue, first of all, because a lot of times they don't really have much operations. What did Facebook buy that was like a multiple of revenue, but it was still like $10 billion? But anyway, and then they weren't even producing revenue, but it was enterprise value to projected revenue, because they're never going to go into looking at costs. So a lot of times companies would just look at a multiple of revenue. But we were saying more established technology companies you could look at in terms of enterprise value to earnings, because it's important to see the operating structure. So we talked about, and that's just an example, right? There's a lot of, we talked about the difference from PE multiples versus EBITDA multiples. When would you be concerned about one versus the other? And generally speaking, I guess the answer I was kind of looking for is, if you're really just concerned about acquiring the company's operations only, you look at enterprise value EBITDA. We talked about the company, the example of acquiring a delivery business, right? And we said, well, if I'm buying this delivery business, I don't care about the debt with that business because it's going to go away. I don't care about the capital structure because it's going to go away. I don't care about the depreciation because I only care about the customers and the routes and the trucks. I want to value the company off of EBITDA because that's indicative of exactly what I'm acquiring. But if I'm acquiring the entire business and the debt's going to be intact and the operations are going to be intact, or I can't separate the operations, then I look at PE. Right? So some companies, when looking at ranges of PE multiples, those ranges kind of are more in line. Right? The multiples are more within a reasonable range. then maybe it makes more sense to look at PE. A lot of companies, EBITDA is more in line than the PE because the capital structures of the companies might be different, and EBITDA wipes out the effects of the capital structure. In a situation like this, enterprise value, equity value area is all over the place, right? This is 0.4, I don't even know what that means. This company probably had no earnings, right? It's tough to look at enterprise value to earnings as a good measure of value in this company. Enterprise value to EBITDA, it's a little bit more in line. It's more in line than the other ones. And that's because if some of these companies have various effects based on debts and depreciation than their comparables, the EBITDA measure strips out all of those impacts. So looking at EBITDA could give you multiples that are more in line in this scenario. So generally, and this is what a P-based analysis would look like. You see a lot of NAs, not available, not available. This happens a lot. Again, not only is it difficult to find transactions that are relevant, once you do, it's difficult to find the underlying data for that transaction. So this probably came from a press release where you read Rite Aid purchased Brooks Eckerd for $2.5 billion with a total consideration of $2.4 billion, including debt, and we couldn't find any other underlying data for it. This happens a lot. And sometimes, again, these multiples will compare us to the comps are extremely high. And Walmart trades at 8 times. This is almost double. It's understandable for multiples in precedent transactions to be higher, though. Why? Why is it understandable for precedent transaction multiples to be higher than just straight up comps multiples? There's a premium. There's a purchase premium. There's a control premium, right? When you're buying a business, you need to buy a business not at the trading value, but a premium to the trading value to convince the shareholders to give you their shares. So this usually includes a premium. But double, it's a little high. Why do you think these multiples are so much higher? Yes, obviously in P-pays because it includes a premium. Why else? Say again? The timing. Right? This is 2007. This is a different market environment. This is a market environment when things are at a peak. And this is another flaw with precedent transactions. Sometimes you can't find any recent deals that are relevant enough. For this reason, these reasons, a lot of times this analysis is just thrown away. But I wanted to show it to you. I want to show you how to put it together. And you probably have to go through the motions in banking. You will most likely have to. So it's important to go through that. So we'll talk about how to interpret this in the football field at the end. Do you have any questions on this?